Hey everybody, John LeTourneau here, Director of Commercial Operations at eXp Commercial. Thanks for joining me for my retail property update and outlook. Some interesting things. It's almost like Charles Dickens said, it's a tale of two cities was a book, right? This is sort of a tale of two markets and that we're seeing some really interesting opportunities and challenges here, but also some really, really good healthy indicators in other segments of retail. So let's dig right in and start with vacancy. Vacancy right now is 4.3% or so nationally. Now that's up 30 basis points year over year. So, okay, it's up a bit. At the same time, super aggressively good number when we average 8-9% over the past 50-ish years. So still a great number there, even though there's some softening. So let's dig into a little more about that. Net absorption, 8 million negative. That means 8 million feet went back to the market and did not get absorbed. Ooh, okay, what does that mean? Well, let's see, where's it coming from? It'll be coming predominantly from bankruptcies, mergers. Look at the pharma industry between CVS, Rite Aid, and Walgreens all closing and moving locations around. So some interesting space givebacks there. We've also seen some high-profile retail bankruptcies continuing to hit, starting all the way back with Sears and all the way through Toys R Us, my favorite childhood home at one point, and many others, even in more current times. So understand this string of retail realignment is continuing. So some big boxes are going back into the marketplace. Okay, malls still weak, a very tough spot to be in that power center. The neighborhood centers, awesome little spot, little strip centers, 5% vacancy on average. But general retail overall has a positive absorption in strip and retail. It's when you go up to the malls and the big standalone single boxes when stuff is being given back. Now, there's almost no speculative development, which is great because even before the pandemic, it was definitely an overbuilt and overbuilding market where too many people got in the game and all had the same great idea, like let's put up a retail center. So a lot of that space is coming back and is sitting. Our 12-month deliveries are 41 million square feet, about 50 million square feet under construction. It's one of the lowest figures in history since it's been tracked. And this is nationwide. So then you're like, ooh, wow, I don't know, what does that mean? Well, it means building costs are insane compared to what they were even 3, 4, 5 years ago. Not just construction materials, labor, as well as building permits, soft cost improvements. It just wow, as far as what they're paying per square foot to build them. What is being built is being pre-leased with a net lease on it, usually coming out of the gate. Think Starbucks, McDonald's, quick service retail, things like that. So very, very intentional uses, known costs without sort of like, well, let's just start something new. Not that random. People are very focused and targeted. However, if you look since 2020, and this is an awesome number to see, is 157 million square feet of obsolete retail has been demolished, which is way exceeding new speculative supply. If I'm a retail owner, I love that. I want that number to be even higher because that means there's less people competing for the same amount of tenants or an even ever-growing number of tenants as more people want to open retail-based trade. So I love when old space goes off the market and I'm still left with my building. Great, tear down all my neighbors. Then I've got the only pizza place in town in my store or in my center. Awesome opportunity. Okay. We're also seeing much smaller footprint per store. People are becoming much more efficient in what they did. It's similar to office. Our sales volume, interestingly, and this is kind of sort of mirroring what we're seeing for opportunity, is sales volume was 66.1 billion. This is up 20% year over year, 20%. In industrial, we saw it fall to almost 1/4 of what it was 3 years ago. Now we're seeing increases of 20% year over year in investment sales here. So a very healthy indicator there. Our fourth consecutive quarterly increase, so it just keeps going. Now, interestingly, cap rates, everyone thought cap rates would go into the 9s and 10s because debt. Still hasn't happened. And if anything, debt is easing. We saw a little bit of a move a few weeks ago. We're going to see a few more probably before year end. So single tenant net leases are still trading at 5s. Stabilized stuff, 6.5, 7s if it's sort of mom and pop retail, little strip centery, things like that. Pharma, which was always like, oh, this is a bellwether. Pharma deals are great. CVS, Walgreens, Rite Aid, those kind of deals with 50-year flat leases, no increases. Always had a bit of an issue buying one of those myself because I have a problem with my money not raising in value over 50 years. However, I understand they're a long-term land and depreciation play, so I'm good with that. But understand those pharma deals used to be trade at super low cap rates. Now they're up in the sevens because there's so much risk in there. They're trying to repurpose them where they can and replace the rent. And often they cannot replace that rent that the farmer guy was paying. Malls, yeah, there's some stuff out there, but boy, malls are a dangerous, scary, risky place to be. So that's a market I wouldn't necessarily jump into unless you got it so inexpensively. You go, we can't lose. But I can tell you, there's no deal so good you can't lose money on it, I assure you. So be aware of that out there, right? Rent performance, national asking rents, $25 a foot, give or take, up 1.8% year over year. Now, again, that's balancing out gross and rent, and gross versus net rent. It doesn't have a lot of concessions built in. Malls are doing okay. We're seeing a lot of growth again in those small little mom and pops. From an investment perspective, interestingly, Raleigh, rent growth 6.9%, 2.4% vacancy. Awesome. Tampa, 4.7% rent growth. Fabulous number. Charlotte, Phoenix, places you'd expect, 5.3 and 4.2% rent growth, respectively. Some challenges. Let's see. Let's put some things together. Los Angeles and Inland Empire, -3%, -3.6. So definitely some challenges in those markets. Chicago, +1.4, but still positive, but not great. Pittsburgh, down 2.7. New Haven, -1.4. Baltimore, -3, which is interesting to see where that's kind of hitting. A lot of space give backs, anywhere from 1 million to 2 million square feet in those markets. So a lot of interesting negative absorption there. But when we talk about our strategic investments, so what does that mean? Where do I go? What do I do? Focus on your high growth Sun Belt, what I call the sunshine smile across the country, starting with, kind of New Mexico, Arizona, Texas, over to Florida. That smile, that is definitely the hotbed of activity all day. Small format, quick service restaurants. Think of the small retail centers with hair, nails, pizza, things that cannot be delivered in a truck like Amazon in terms of a commoditized thing. It's not like small retailers are going into 1,000 feet and going to compete with big box online retail. It's not going to work. It's not going to happen. So the focus on those micro tenants is great, but if you are going into mid or upper size, focus on quality of tenant, term as always, and the drivers around location in terms of the absolute demographic certainty that, hey, this is the right place to be with this use. The nice thing too, and this is kind of a cool thing, is that the super high cost per square foot to build due to all the construction costs we talked about means that if I do have a great location, it's worth even more, only because someone would have to pay a very dear price to acquire the land near me and then have to build a building at today's pricing when maybe I bought it 4 or 5 years ago then. So I have kind of an island around me because no one can come in and make money for much longer because it'll take them a lot longer to recover that. So if you're going there, avoid markets with high legacy stock. Old retail, people used to chase B and C markets. They'd say, hey, I'll take an old building and see what happens. Yeah, that's there, except the public is not buying as much there when they have an option. So watch out for that. And I'm talking older malls, things like that, large, big department stores, people just not there, okay? Huge pass-through cost markets. You go, hey, I got $10 rent. That's great. But if your pass-throughs are 15, you didn't get $10 rent. So watch out for that. We talked about our national vacancy and our net absorption. Overall, again, that sales volume at 66 billion is still a really healthy number. So there's great opportunity in the market, great headwinds at the same time. We talked about this being kind of a tale of two cities or two markets, and it definitely is. So if you have any questions on this, please reach out to me or any eXp commercial advisor. We're in every market in the country and happy to help you any way we can. If you are an eXp commercial advisor and have questions on it, please reach out to me or the operations team. We're happy to help answer anything we can for you. Thanks so much for your time on our retail update. Look forward to seeing you soon.